Thanks a lot. Okay, so I don't have that much experience. I have mostly experience in equity markets, Indian equity markets, although I have done a little bit as a hedge fund guy, for about 8 months, but taught me a lot. Very stressful job. But, let me do one thing. I will share my screen. So, listen, I think in general, let me just start with this. I feel that in general, in the world of AI, what's going to happen is that people are thinking a little less critically. I think a lot of people depend on AI to make their thought process. Nobody's actually going down from basics. So I'm going to start with a few subjects. I mean, I actually have a lot of subjects to discuss. But these are my favorite subjects, so I'll start off with this. I think I want this to be slightly interactive. Okay. So if some of you want to come on video, please come on video. And the reason is that, it's a question that I generally ask a lot of people in interviews as well to see how they critically think, because I think that's one of the most important things if you want to excel in any field. For example, one of the questions that I ask is, how big is India's middle class? Can anybody answer that? Anybody can shoot. What percentage of India's middle class? Anybody can, unmute your mic and answer that question. Nobody knows. Seriously? You guys are MBA grads?
I think we have some messages on the chat too. Someone says 70%. Yeah.
No. Seriously, anybody can just, unmute themselves and answer this question. I wish there was a way to do some sort of a survey. Okay. Shucks, people are so scared. Listen, I really want this to be really interactive because that way I can actually, help you guys out here. Alika, what about you? What do you think of India's middle class? What size?
Okay, I think maybe around 50 to 60%.
Wow. Okay. And how do you define middle class? Person who can buy a two-wheeler, person who can buy a car. A cheap
person
car.
who can buy a two-wheeler and a cheap car, maybe.
Oh, two-wheeler is a middle class, is it? So in the guys who deliver food on Zomato is a middle class guy?
Not necessarily.
Yeah. So, okay, fine. So let me define middle class, right? I think the basic when you define a middle class in India is that I feel it's somebody who can actually, what do you call, at least afford to buy a Maruti Alto. I'm sure a lot of you guys, aspire to buy better than that. But I think Maruti Alto is probably the cheapest two-wheeler passenger vehicle in our country. And typically an Indian has a single income earning person. They have two kids to go to school. They probably rent out an apartment or a little house, or they take a mortgage. They have utility expenses, food expenses. Utilities could be, your mobile data connection. I'm sure if I have a home broadband, it's not considered to be, you need to have a home broadband. I'm sure that if you can't afford to have a home broadband, you probably are questioning whether you're middle class. But if you were to consider all these costs, including your college, school, education, right, for two kids, transportation, all of that. I think the bare minimum, and as I said, a car and probably fuel and transport and all of that, I think you could probably say that the monthly expenditure for a person would be about 55 to 60,000 rupees a month, which makes it about close to 7 lakhs a year. Okay, if I were to define 7 lakhs a year as the bare minimum to breach the Indian middle class, and then above that, so everybody above that is middle and rich, then India's middle class is actually only 6.5%. That's it. Okay. If you go back, there's a very interesting report back. I'll try and see if I can find it. I'm going to be using my screen as well, and this is very important when you guys are business managers. When you guys go to FMCG companies and try and try and assess what market sizing is, it's very important to understand this. I mean, in fact, what you probably would notice is like if you look at the monthly number of consumers who order monthly on Zomato, Swiggy for food, the monthly number of consumers is only 22, 23 million people. That's it. It's not like everybody can order on that, and they are spread across the length and breadth of our country. So the next question is that how do you come to this data? Okay. I think there are two ways of getting, coming to it. One is to actually look at income tax data. And another question people are going to say is that, a lot of people in India don't pay income tax. True, right? The businessmen. But there is a way and mean to actually connect. So, which is why I'm saying, the session is going to be about how to think differently. For instance, if you were to go to the CBDT website, right? Let me just Google. So there is something called CBDT website tax series. Okay. Then. See, here you have a lot of data out here. You actually can get to know how many people in India actually pay income tax, right? Income tax data series 1 minute. Let me just see. I think this is the latest one. No, this is not. Sorry. Okay, just look at this data, for instance, right? This is, data 2023. This actually gives you the total number of people who, earn salary. This is gross income, and this is salary. So if you actually look at this data, right, you guys can see my screen, right?
Yes, sir.
You can see my screen. Yeah. So you look at this data, you can actually see this is just people who earn salary income, right? And then obviously there are a lot of people who earn beyond salary, right? So you can actually go your gross income, and then you can go to house rent. So some people earn income through house rent, some through pension, all of that stuff. But the point I'm trying to make is that if you actually add up a lot of this, right, and do a rough cutoff over here, right, and say, okay, I make an assumption that a large part of these guys are actually below 5.5 lakhs, and what you want to do is try and assess how many people are above 7 lakhs and above. You might get a data point of about 18 million people. That's it. So you have 18 million people in India who actually earn a salaried income of greater than 6 to say 7 lakhs roughly, right? I could be off here by a couple of 1 million, 2 million on the lower side possibly, but that's it. That's what India's salaried middle class is. But then the question is then how do you assess the non-salaried guys? So there's if you actually go to the non-salaried guys, then you can say business income. If you use this data, then you actually end up with a figure of about 4 million people. And you say, my God, only 4 million people who do business actually earn an income above 7 lakhs. That seems a little low. So then you connect data points, right? For example, what do? You look at car sales, right? Car sales, roughly, if you were to go to meet a manufacturer of cars in India and ask them, how much are the sales of cars between salaried and non-salaried? More often than not, they will say, so it's about 50-50. Right. And, so if you were to go to a company that gives out mortgages like a bank or a HDFC Limited, now it's merged with HDFC Bank, or any mortgage company or a bank gives a home loan, you ask them what proportion are sales, home loans are actually to business, to salaried and non-salaried. They will say roughly 55% are salaried, 45% are non-salaried. So if I were to take these two data points, right, on cars and homes, which are primarily the most important investments in your life, apart from education, you probably see that the ratio of salaried to non-salaried people who have that income to actually buy a car or buy a house is actually roughly about 1:1. You got the connection, right? If it's 1:1, then you say, okay, fine. So we figured out that the number of salaried people out here probably are 18 million or 19 million odd. So it means that the number of non-salaried people who have that income to actually afford that are also 18 to 19 million, although the number of disclosures officially are only about 4 million. right? And then I could say that, listen, I'm saying that the business guys, for every business guy who discloses an income above 7 lakhs, there are three others who don't disclose, which makes it a very fair assumption. And you say, yeah, that's very possible. So then you take this entire big number of 18 million on salaried and 18 million on non-salaried, or 1:1, or in 1919, whatever way you want to cut it. And then you say, okay, you know what? But some of them are double income, like your husband and wife could be both earning, right? So you want to try and figure out how many families, right? So then you say, okay, maybe 25% of them are, have an overlap of husband and wife. So you reduce that number, 38 million, by about 15% to take care of, because I'm counting double, right? Husband, wife. So you take it 15%. So then you reduce 38 million by 15%. You probably come to about 31, 32 million. Right. And then you say, okay, what about, there are a lot of pensioners in our country. I don't know how many of you know, but 15%, sorry, about 8, 9, 10% of income taxpayers are actually pensioners. Right. But those pensioners are probably above 60, 65. Aleka, are you smiling? I hope I'm not saying something funny.
No. Yeah.
Okay. So I think that's it. So then you have old people, and mostly they don't buy cars, right? And then you say, okay, fine. So you look at the number of people who actually go, and a person who's 60 usually doesn't buy a house. Your biggest investment is usually done. So then you reduce that further by maybe about 10%, and you come down to about 31 million. Reduced by 10%, you come down to about 27 million. So the entire population of people who can actually buy a car is just 27 million. Now, let's put in, and how do you, if you look at the total number of cars that are being sold in India annually, right? Let's take an example. Sorry, 1 minute. I think it's roughly, so 43 lakhs, 4.3 million. Now, if you were to actually then think about it, a businessman, a lot of them buy cars, they buy it every 3 years. Do you know why? Depreciation benefits. So they change the car every 4th year, almost. While a salaried person probably buys a new car every 8 years. You take an average of 4 and 8, you get 6. So then you say, okay, fine. You have 43 lakh cars or 4.3 million cars getting sold a year. You multiply that into 6, or the other way around and say, okay, there are 27 million people who actually, remember I brought it down from 38 million to 31, and from 31 to 27, 28, because I reduced it by 10 so the 27 million, if I divide that by 6 years, which is the average time span of a car, I get a figure of about 4.5. So actually, the total number of cars that can be sold on an ongoing basis in India is only at 4.5. You cannot sell more than those number of cars, which is one of the reasons why car sales in India will stagnate. It's not the big middle class that people talk about. It's 60%, 70%. Actually, if you think, look at India, right? I think back in 2019, 10% income, 25,000 India income report. See, yeah. So there was a report published by the Indian government that if you earn 25,000 rupees, you actually are top 10% of India. Can you imagine that? That's like nothing, right? That's like pathetically low, right? I mean, to be top 10% of India, you're just earning less than 10,000. So anyway, coming back to, I just want to say, I want to just show you that, this is one of the ways to actually connect dots, right? By, our middle class. And this will help you to understand when you assess businesses, when you go back to industry and try and figure out what is a TAM, or, total opportunity. You have to understand that these are the restrictions you got to work out with. Most people will say it's a huge, the market's massive and huge and huge and huge. It's actually not, which is why if you talk to a lot of FMCG guys across the industry, the one struggle that they're all facing is that volume growth in India is crap. It's not growing at all. It's barely 2-3%. So, that's one thing. So I want to just stop there. I can go along on this particular topic itself, but I just want to flip fast. And, I might not be able to finish a lot of my topics in 1 hour, but, we could always come at some other time. The next one is, this is a very interesting model, because for anybody in finance, everybody uses DCF. Everybody uses, market efficiency theory. Everybody uses a CAPM model to value companies. A lot of people out here in finance want to get into investments. They want to get into fund management. They want to get into equity sales. They want to get into equity research. And all of them would have taken a lot of topics where they've learned about a market efficiency theory, DCF, the cost of equity, cost of capital. I think you should stop. You should dump that totally. Okay, it's useless. It doesn't work. In fact, today, the very person, and I don't know how many of you have heard of this guy called Dr. Eugene Fama. Okay, Dr. Eugene Fama is he's the father of modern finance. He's the one who actually did, he was a Nobel laureate. You can search for him on the web. Dr. Eugene Fama. He's a Nobel laureate who actually is known as the father of modern finance, which is what you study in B school, right? He incidentally about 8 to 10 months ago said you actually need to dump all of this stuff, right? The same guy who designed all of this stuff, and the reason is. There's a very interesting thing that's now happening in the world, right? We've always been taught that, so let me put it this way. What is market efficiency theory, right? Market efficiency theory says that all news is priced into the stock price, right? And if that is true, it doesn't matter if a person buys or sells a share, because if a person buys a share, there's always a seller. And the person sells a share, there's always a buyer. That's how the stock market works, right? There are millions of buyers and sellers. So if all news is priced in, which is what market efficiency theory says, then regardless of the buying and selling, there should not be any impact on the market cap of the company, because there are equal buyers to sellers, right? You'd agree. But here is the interesting thing. So that is one key important caveat, that market efficiency works only when you have a super efficient market, which means there are enough millions of buyers and sellers. But here is the interesting thing on the US. Let's take the US market, because most financial theories have come out from that country, right? Let's take the US as an example, the mutual fund industry out there, right? The mutual fund industry out there, there are hundreds and hundreds of mutual funds. But guess what? The active mutual fund industry is only now 45% of the industry. The remaining 55% is ETF. So let me put it this way. If I were to take 100 rupees and put that money into a mutual fund, depending on which fund manager I put that money into, he will buy different stocks. But if I put the same 100 rupees into an ETF, there could be hundreds of ETF issuers. It could be an ETF issued by Nippon Mutual Fund. It could be an ETF issued by Axis Mutual Fund, HDFC Mutual Fund, and all of this. I'm guessing that people are familiar with the concept of mutual funds, right? So regardless of which mutual fund you put that money into, on the ETF side, the same set of stocks are bought. So in some sort of sense, all the buyers, all ETF issuers, they buy the same stocks and behave the same way if you put the same money inside. While active fund managers, if you give them the same amount of money, all of them buy different types of stocks, depending upon their portfolio, because they all have different portfolios. But I also mentioned earlier that 55% of ETFs, 55% of the mutual fund market in the US is an ETF, are ETFs. And only 45% is equity, which means actually there is only one party who's 55% of the market. And the remaining 45% of the market are other 100 buyers and sellers, which are the mutual funds. So the concept of an efficient market doesn't exist if there is one large guy, which is an ETF. Effectively, since all the ETFs behave the same way, it's like having one ETF who's 55% of the market. Are you guys with me on that? Yeah?
Yes, sir.
Yeah, you understand, right? So then your market is not efficient. So incidentally, sometime in 2021, there was a very interesting set of finance professors in Europe who came out with a theory called market inelastic hypothesis. What they said is that because of the market structure being like this, they found out that when they said that, let's figure out whether market efficiency theory works. So they said they looked at data of people of buying and selling impact on the stock market. So if somebody bought $100 of a stock of a company and sold $100, what was the impact on that price? Because if all news is priced in and there was no news in incremental news in the stock, there shouldn't be an impact on the stock price. But what they discovered is that if they bought $100 of stock, the impact was not $100 on the market cap of the company. The market cap went up by $300. Or they sold $100, market cap went down by $300. But market efficiency theory says that there should not be any impact at all. So and they said, for practical purposes, Dr. Eugene Fama and everybody said, there could be a $1 impact for every $100 of buying and selling. But here, it was not $1 impact, it was $300 impact. So that's what they called as the market inelastic hypothesis. Let me try and, pull that out, just 1 minute. You guys should read about it because, yeah. So read about this, okay? It was basically, it was developed by these two gentlemen out of Europe, and you guys as finance guys should read it. And when they basically said that because the market structure is not efficient any longer, markets are not reflecting the concept of efficiency theory, and hence CAPM model doesn't apply. Hence, if CAPM model doesn't apply, then cost of equity doesn't apply, and cost of capital doesn't apply. So you should actually throw out DCF. DCF will never work. That's something that finally Dr. Eugene Fama, what did he say about says market efficiency does not work. Where did he say? Sorry, I'll try and figure that out. He says, he came out with an article recently. I am unable to find it at the moment, but he basically, admitted that market efficiency theory doesn't work. I'll try and locate it and share it with Aleka a little later. Okay. So, sorry, are there a lot of questions? Okay. Wow. Okay. Fine. Cool. No, actually just comments. Cool. Anyway, so going back to my presentation. Yeah, so this is something I know it's very hard to accept because, you guys are probably going through sessions and classes explaining about CAPM model, and some of you guys are actually doing your, not CA, but rather your CFA. And they're doing market efficiency theory and all of that. Trust me, it's not going to work in the real world. And if you were to use that in the real world, then you're going to always lose money. I don't think anybody wants to lose money investing. And I can, there's one more issue that's happened. What has happened is that because of this concept of market inelastic theory, let me just pull up something interesting, right? Let me see that. Okay. So, what I was saying, okay. Okay, so you've heard of this concept that as interest rates go up, then what happens is that, the cost of capital increases. And the cost of capital increases, people shift money because when your cost of interest goes up, interest income assets become more attractive. And as the cost of interest goes up, your cost of capital goes up. And so valuations of equity comes down. That's what I've heard. Right? Unfortunately, if that was the case, then as the US raised interest rates a lot, you should have seen a massive fall in US markets, right? If you guys remember that back in 2022, the US Fed raised interest rates from 0, right? It raised interest rates substantially. And yet, initially US equity markets fell a little bit, but today, at such high interest rates in the US, the markets are still high, right? And ideally, typically what we've learned is that as interest rates go up, as people try and sell equity, buy more debt because debt is more attractive. And if you think about markets like the US and Europe, where a large part of the money is actually managed by asset allocators, pension funds, endowment funds. I hope you guys are familiar with these words called pension funds and endowment funds. They allocate money based on they want a maximum or minimum, in a total return of about 5-6%, because those are developed economies where inflation is generally quite low. For them, they need to pay their pensioners and endowments about 5-6%. They're very happy with that. So if your US tenure, for instance, is about 4.5%, your corporate bond yield in the US will probably be 5.5-6%. So I don't need to actually invest in any equity. I can actually allocate all that money to debt, right? I don't need to invest in equity because I'm getting that 6%. Why do I take the risk of equity? And so a lot of people sold equity thinking as interest rates go up, they sold equity and then bought debt. But guess what? Markets still went up, regardless of where the interest rates went up. And the reason that is happening is because what is happening is that the asset allocation is not getting driven by interest rates any longer. Okay, it's getting driven by a concept called volatility. Okay, so volatility. Okay, let me put it this way. This is a little complicated. It could take a long time also if in more detail, but I'll make it short and sweet. I'm an asset. Let's think of a bank. Okay, a bank has equity capital. The bank gives out loans. Different loans have, depending on who you lend it out to, has a higher risk, means they can lose more money, and has a lower risk, which they can lose less money. And the RBI has regulations saying that if you, depending upon which type of exposure, whether you have home loans, car loans, personal loans, or corporate loans, you have different risk weight attached to each type of loan. All right. So the higher the risk, so depending on if I have a certain amount of capital, depending on what exposure I have, I have a certain limitation on loan exposure to each segment based on the risk of each segment. Right. So likewise, you have asset allocators who are endowment funds. What are endowment funds? People give them money, and then when they retire, they have to give that pension back or whatever, payment back. So what they do, these endowment funds, as I told you earlier, have to pay probably a 6% annualized return to those guys when they take money out or when they have their liabilities. So they invest in different types of asset classes like equity, debt, gold, commodities, and forex. These are the five broad asset classes: equity, debt, gold, forex, commodities. And depending upon the volatility of each asset class, if my volatility of an asset class is very high, if my volatility of an asset class is very high, if my if my capital is limited, it's just like a bank. A bank, if I give more riskier loans, then I can give to that segment a lesser number of loans. To a very low risk asset class like a mortgage, the risk capital against this is very small, because if the person doesn't pay mortgage, then I can take the home and I can sell it. Like a gold loan, if I give a gold loan, the risk against this is very low, because I'm basically taking the person's gold and holding it and giving money against it. I can immediately monetize the gold. It's very easy, right? You don't lose money. So the risk capital against the gold loan is also low. So what happens is that, so what I'm saying is that if an asset class has got a higher risk, which means higher ability to lose money, it's also like volatility, right? Volatility means the asset class can go up fast and go down fast. So I can lose money, I can gain money very fast. So there are ways to measure riskiness of volatility of these asset classes. So if, for example, you would have heard of this word called, just 1 minute. You would have heard of this word called VIX index, I'm sure, right? So here is the interesting thing. Your VIX is, where is that? This is your VIX index in the US, right? Don't look at this word US Treasury. Ignore it. It applies to the next one. This is the US VIX index. It's the volatility of equity asset classes. And as you know, your volatility has been falling down. But here is the interest, and this is as interest rates were going up. I remember I told you interest rates were rising in starting 2022 when the Fed came and you had the Russian war. Ukraine-Russia war happened somewhere in Jan 2022. You can go back and see that date. Your interest rates are going up because the Fed started raising rates, but your volatility of equity started falling down, surprisingly. Similarly, what's also here is interesting. This is called the bond index volatility. It's an index called MOVE, MOVE. It's available on Bloomberg. And this measures the volatility of US treasuries, right? What's interesting is as interest rates were going up, the volatility of debt actually went up. Now, why did that happen? It's simply because as the market started getting concerned that the US is going to actually issue more number of bonds, and you probably would have heard after the Russian war that US confiscated all the Russian assets, right? And because of that, people stopped trusting the US bonds or US. They started moving some exposure to US, to gold, stuff like that. So what's happening out here is as rates were going up, your volatility of equity was actually falling down, and your volatility of debt was going up, which meant that I can allocate more money to equity even if interest rates were going up. And as interest rates were going up, ideally I should have put in more money in debt, but my volatility of debt was going up. And so I was reducing my exposure to debt, which is one of the reasons why you had a lot of, stock companies like, for example, Tesla, where you were having earnings cuts, right? And the stocks were still going up, right? Ideally, when companies see earnings cuts, stocks fall. That was not happening because you were increasing exposure to equity because your volatility of equity is falling down. And you were reducing exposure to debt when volatility of debt was going up. And how do you increase exposure to equity? You just buy ETFs. And ETFs don't care about valuations. So you keep buying more and more ETFs, and ETFs don't care about valuations, and stock market valuations just keep going up. So it's very, very counterintuitive. But the point I'm trying to say is that earlier, pre-2020, asset allocation and equity valuations were driven by interest rates. Starting 2021, asset allocation was being driven by volatility of the asset class. And okay, there is a reason why equity, volatility came down. There is a concept called 0-day options. Okay, I don't know whether it's over here. Okay, just search for this concept called 0-day options. Okay, ODDE. Okay, and just search for okay, let's just take out this for instance. This 0-day options, right? It just picked up in a massive way in the year 2021 and just kept on going up and up and up and up. So what was happening for people who understand derivatives, as the number of options getting written keep on rising, open interest rises. And now the stock market is not controlled by people who buy and sell stock. The stock market is controlled by people who are selling these options. And I'll try and see if there is record. I think there was option. So this year, I think this is it. Which is that? Just give me a second. News. Yeah. So this year, no, not this. No, it is in December. Okay. Okay. So there was this article written, I think, on the 18th of December, This was the largest expiry of options ever. $7.1 trillion of options expired on that day. And these options are nothing but 0-day options. What a 0-day option? Starts in the morning, expires in the evening. Most of the time when you've learned in finance is that 30-day options are typically what trade. So the US had an innovation in 2018, 2019, and it became very popular in 2021. It was called 0-day options. They're like, if you go to, let me explain it. If you go to I don't know how many of you guys have ever gone to a casino, but a very popular machine in the casino is called the slot machines. You just put $1 and you move it down, right? And you probably hopefully get those three numbers in one line, and then automatically, if you're lucky, you win. So those are called slot machines. You don't need to use your brain. You just keep putting $1, pull it, and then hopefully another dollar, pull it. Your loss is only $1 at a time. Likewise, 0-day options, because the option expiry is is just one day, the cost of an option is nothing. So a lot of people love it. It's like betting for 1 rupee. So which is why 0-day options became very popular. And because they became extremely popular, the option expiry has become so large that the entire market is now controlled by options. It is not controlled anymore by fundamentals, which is one of the reasons why Elon Musk's stocks have gone up. I mean, Tesla is getting screwed by the Chinese, right? It doesn't matter. Stock's still done well, right? It goes up, comes down, but the guy is still very rich, right? In a very rational market, he would have gone bankrupt by now, right? Because so the thing about ETFs is they buy the biggest stock the most. It doesn't matter whether the valuation makes sense or not. And as your 0-day option rises, option expiry increases, the volatility of the index collapses, and as a result, they buy more equity through ETFs, and the equity ETF buys more Tesla stock. Tesla stock goes up even further. So what I'm trying to say out here is that we are in very different times. Whatever you've generally learned in finance, in terms of DCF, in terms of market efficiency theory, none of this is working, because what's driving money is actually a completely different concept. One is 0-day options, and one is market inelastic hypothesis that I spoke to you about. Okay, that is the reason why our economy can do really badly, but the stock market can do well. Okay, so let me just 1 minute. Aleka, what's the general feedback? I know there's a lot. I don't know. This could be very complicated, right? So I'll give you another very interesting example, another subject which is quite interesting. You hear a lot of this stuff saying that the US dollar is going to go down. People are going to change the reserves. The US dollar will weaken. Everybody is, the BRIC countries are going to sell the US dollar. They'll buy reserves in other BRIC countries. India, China, Russia, all of these countries are going to screw the US. It's all humbug. Okay. See, please understand one thing. There are, the strength of a currency is not driven by forex reserves. Okay. Forex reserves are generated from trade and capital flows, right? The strength of a currency is actually driven by how often you use a currency. Okay. So if I look at all the transactions in the world of currencies, guess how much? There are two types of transactions. One is trade-related transactions, and one is capital-related transactions. Okay, like for example, I transfer capital, I buy options, I buy futures, I buy stock, or I give a loan. These are called capital-related transactions. And then trade-related transactions. I export something to a country. I import something from a country. Those are called trade-related. And Forex is generated by trade typically, and then obviously by capital flows. So if I change my reserves and say, okay, I'm going to dump US dollars and I'm going to buy something else as reserves, the question you're going to ask yourself, what really are you going to buy? Gold? You can't buy too much gold because you can't really transfer gold. Are you going to buy Chinese currency and store it at Forex? No, I don't think so. Are you going to buy Russian ruble and store it at Forex? No, you're not going to do that. I don't think Indians will trust Russia. Who will trust the Russians? Right? So, but let's put it this way. I'm going to ask a general question, and if you guys can answer it, it'll be helpful. What percentage of your capital transactions are trade related, and what percentage of your forex transactions are capital related? Can you guys please answer in the chat if you can? Let me repeat this. If you're going to answer, you can answer as well. What percentage of transactions are capital related, and what percentage of forex transactions are forex related? No, but give me a percentage.
10% to 90%.
What is 10?
Trade related.
And 90% is capital.
Correct.
Okay, fine. You're right. Roughly about 7% of transactions are trade related. 93% of transactions are capital related. Why? If you just take any other country in the world. So even if you did all the trade in the world in Chinese yuan, you're only replacing 7%. But you know that US is the biggest economy. So you'll always have to deal with dollars. Right? The remaining, what I'm trying to say is that 93% is capital related. Now let's give an example, right? If an Indian company borrows from abroad, or a Chinese company borrows from abroad, or a European bank borrows from abroad, or a US bank borrows from abroad, or a Swiss bank borrows from abroad, all of them, Japanese bank borrows from abroad, they all issue US bonds. Right? Everybody issues US bonds. No, does anybody issue yen bonds? Hardly anybody. Did anybody issue, Russian bonds in rubles? Nobody buys them. Do people buy Chinese bonds? No. In Chinese yuan, hardly anybody buys them. Even the Chinese companies issue US bonds. So because the US is the dominant, US dollar is the dominant currency for issuance of bonds, you effectively have to hedge. Suppose I issue a bond from India, then I have to hedge my currency exposure. So that's also hedging in dollars. If I want to split up the interest and the principal payments, I hedge that part. If I want to change it from a fixed to a variable, because when you issue a bond or issue a borrowing from a foreign bank, say an Indian company is borrowing from JP Morgan, the interest rate is LIBOR or SOFR plus a spread. And SOFR and LIBOR are both variable, right? And I want to convert that variable interest rate into fixed. So I use something called a swap, right? I swap from variable to fixed. Again, that is dollar denominated swap. So everything is a swap, is dollar denominated, which is why the dollar will never weaken. So this fallacy that the dollar will weaken, get it out of your head. There is no replacement for the dollar. The only replacement for the dollar is probably Bitcoin, right? But again, no country in the world, very few countries in the world want to accept Bitcoin, because once they accept that Bitcoin is the currency, they can lose control of their own country and own currency. So nobody wants to do that, which is why, I'm just saying that this concept that you keep hearing in the newspaper that the dollar is going to weaken, it's all nonsense. In general, as good, MBA grads, I would generally say most of the media in India do not even read it. It's a total waste of time, because analysis out there is very one-sided. There is no rationality today in Indian media, unfortunately. There are very few Indian media houses actually are rational. But yeah, this is, I just want to sum that topic. I also have a very interesting, there was a very interesting comment, I think, by the central bank, RBI governor recently, says, again, I think a lot of people would have heard recently that a lot of people are investing in mutual funds, insurance premiums. They're buying shares. As a result, bank deposit growth has been very weak, right? So I think RBI said bank deposit growth weak because of mutual fund investments. Let me see. One minute. I forgot where it is. I think, yeah, it's yours. I mean, there are many articles where the RBI governor has said, um, you know, okay, so there are a few comments, I think pushes for growth based. Sorry, I can't find that comment, but it basically says that bank deposits growth has been falling because people are investing in mutual funds and insurance policies and buying shares. That is wrong, completely wrong. Let me explain. Right? Suppose I have 100 rupees in my bank account. I buy a mutual fund. That mutual fund, then money goes to the mutual fund, and it takes money, and my bank account reduces. Right? Now that mutual fund goes and buys a share. So now money goes out of the mutual fund's account to the person who sold the share. Okay? And the mutual fund buys that share. But the person who sold the share gets money in his bank account. So where the money is still in the banking system, right? So there's no relationship when a corporate issues a new share and sells a new IPO. Your money is going from your bank account to the corporate's bank account, but the corporate's bank account is still with the bank, right? So there is no relationship at all between anybody investing in stock market or buying insurance premiums or investing in shares and bank deposits. But you would have heard so many people say that, including our, respected RBI governor, right? So again, I hope this you find this interesting in terms of it completely, but you can search for those comments made by a lot of people saying that these wrong concepts. Okay, you need to what I'm trying to say is that question basics, what you hear. Don't believe in what you hear by big stalwarts. Because they are big, that doesn't mean they are correct. Just simply start thinking. Does it make sense? Where does the money go? Start from basics, right? That's what I was trying to say about critical thinking. Just start from basics. I'll give you another very interesting example. So I've already discussed this part, what drives the strength, right? And I'll give you one very important thing. You do not bet against the US. Why? Do you know that the US is the biggest producer of crude oil in the world today? Okay. So they have crude oil, energy. They have the best universities. They have the best technology. They have a very low average age, because we talk about demographic dividend in India. They also have a demographic dividend. And they also have replenishing demographic dividends because all the smartest people in the world go there. They have a system that works, and their biggest asset is they have the US dollar, which is their reserve currency. So effectively, when you buy the dollar, you are funding them free of cost. So you're giving them free funding. They have excess energy. They have smartest people. They have technology. They have enough of land. How can you even win against them? Right? So my biggest investment, by the way, was buying US shares 3 years ago. I said, I don't think India will do well. I'll buy US. And I'll buy NASDAQ. I didn't have to buy any stocks. I simply bought NASDAQ. I said, because I'm buying the smartest people in the world. Right? And you see the difference in the stock return between NASDAQ and Indian Nifty. Huge difference. I didn't have to do any analysis of shares, nothing. Very simple basics, right? So, I just want to know. So coming back to this, right? No, I want. Yeah. So I'll give you. This is an interesting example I want to give you. Don't be scared of even the biggest people in banking. Now, I know a lot of you would have heard of this guy called Uday Kotak, right? He's the guy who founded Kotak Bank. I challenged him once, not face to face, of course, but in his theory. So I'll share this with you. Just hold on. Let me see if I can share it. Uday Kotak, COVID, retail, stress, raise, bank, capital. Yeah, see, this is what Uday Kotak said. Indian banks need capital to face coronavirus pandemic, right? And he says the need to raise $20 billion of capital, which is half the banking system capital, because he got worried about COVID is going to hit all the banks, right? Because everybody stopped working during COVID, or the country shut down. So everybody listened to Uday Kotak because Uday Kotak is the founder of Kotak Bank. And this is in June 7th. So what I did is I did a very interesting analysis. Remember, I talked to you guys about the retail banking credit. You guys can see my screen. It's a plain black. It's a plain notepad, but I will just explain to you very simply. Right? You guys can see my screen, right? It's just a plain notepad.
Yes.
So guess how many home loans are there in India? Home loans. We have a population of 1.4 billion people. We have 350 million households. I'm assuming that each household has got 4 people. So 1.4 divided by 4 is 350 million. Guess how many people own a home loan in India? Just 17 million. That's it. 17 to 18. That's it. Tiny, right? So something like 17 to 18 max. Remember I told you how many middle income people are there in India, households? I said about 28 million, right? Remember I did that entire analysis where I came back from initially 38 million, and then I reduced that by 15% to account for double income houses. So 15 less. And then I reduced it further by 10 for senior citizens, right? Just say DINGs. Double income is DINGs. Okay, double income and not married or whatever, something like that. Double income without kids. So you then finally came down to 28 million, right? That's how I came out to. But there are only this many home loans. Car loans. Same, 17 million. That's it. Or 18 million max. Tiny. I mean, think about it. You would generally think that everybody's got a car. But actually, less than 4-5% of Indians actually buy a new car. That's it. So if you've got a car at home, trust me, you are rich class in India. Okay, you're not middle class. Everybody likes to say they're middle class. They're not middle class. So what happened is that what I did was I said, okay, you know what? The total number of the major retail loans in the banking system, right, were home loans, car loans, loan against shares. There was only 2 to 3 million home loans against shares. Okay, personal loans. Again, from the banking system, 22 million. That's it. Only 22 million personal loans. Credit cards, not an issuance, because, for example, I have 6 credit cards, but I'm one person, right? So a lot of people say we have 85 million credit cards in issuance, but we need to look at how many unique credit card holders are there, right? So this is analysis that I did in June 2020, right? And the total number of unique credit card holders was 21 million or 22 million. Unique credit holders was about 21 million. So you can see that there is a correlation between the total number of personal loans with the unique credit card holders. Because a personal loan is a little better form. A credit card is more risky because you don't have much documentation, right? So if you notice one thing out here, all these numbers, 17 to 18 million home loans, 17 to 18 million car loans, loan against property, there's something called loan against property. Loan against property. Okay, again, I think there's about 2 million over there because you have mortgages, right? That's the other way. So you have mortgages, which is where you're actually buying a home, and loan against property is where you're just taking a loan to do some others. Maybe, for example, you're doing a business loan. So all these are basically the primary retail loans. And you'll notice one thing. All of them fall 21, 22, 23 million people. And in effect, they're a subset of the 28 million people, right? 28 million is the big set. And within that, you have a smaller set. So I can conclude from this data to say that, guess what? All those people who earn 7 lakhs and above, right? All the people, remember I came on this 38 million of people who earn rupees 7 lakhs per year, right? Yes or no? Right? That's my starting point. So starting point is, I said, all these people earn above 7 lakhs. How many such people are there? And I came down to 28 million households. But all those people who home loans, car loans and everything else was actually lower than the 27 million. So what will a bank do? They'll first attack the people who can afford that, right? Because they're the safest customers. So now here is the interesting thing. I came across a very interesting report by this guy, Credit Vidya. Credit. I don't have the report now, but this Credit Vidya. I don't know why my thing is not working. So I came across this report by a fintech called Credit Vidya, which actually was tracking. See, everybody's mobile phones, you have apps, right? So those apps actually steal a lot of data from you, right? All your SMSs, they read all of that. So this particular company called Credit Vidya, they were getting data from about 2 million handsets across the length and breadth of the country. Okay, and they were doing analysis of that, and they said that after COVID, people above 6 lakhs of income, they did not get a hit on income at all. Okay. While people below from 6 lakhs to 3 lakhs per annual income, their income was fallen by 15%. And those below 3 lakhs per year, which is 25,000 a month, their income had fallen by 25%. You would kind of, I don't know how many of you guys, what we were doing during COVID times. I think you probably were all in school, right? But during COVID time, the poor people got hurt the most. The maids, the helpers, the delivery. I mean, I'm just saying all those the retail guys who are, delivering to your home, or the car guys who are selling cars, or mechanics, all of those people got hurt the most, right? Because people were going to restaurants less. So restaurant people. So a lot of unorganized people got hurt the most. And those were low income persons. But people who had salaried and who were earning slightly better, their income did not get hit during COVID. In fact, their savings increased during COVID because they were not spending money. So if you think about it logically, if the people above 7 lakhs of income did not get hurt because of COVID and their savings actually improved, how will they default on a loan? You guys are with me? If my income did not get hit because of COVID and I saved more because I didn't spend, because of COVID, I had to have restrictions of going to a restaurant, travel, all of that. I actually saved more money. And most of the money went into the stock market, which is the stock market went up after COVID. Right? So if people did not if people's incomes didn't get hurt and they're having saving money, how can they default on a loan? If they didn't default on a loan, what was Mr. Uday Kotak saying? He was completely wrong. Right? Uday Kotak is supposed to be Kotak Bank, but he said something completely wrong. In fact, the year 21, 22, 23 were the best years of retail banking credit India's ever experienced in its history in terms of stress. completely opposite of what Mr. Uday Kotak said. And you could have just done this analysis by simply going to basics. Very simple. Right?
Sir,
Okay.
I have a question.
Yeah, go ahead.
You mentioned that Mr. Uday said we needed 20 billion, and you said that is half of our banking system's money. How did you?
This was then, back in 2020.
How would you estimate this now also? Or this is
How would I
available?
estimate? No, you just go to the RBI data and look at the equity bank capital of the banks. Obviously, equity. See, so because of what he said, banks actually raise that much capital, so your capital grew, and then banks make profit, right? If you look at the banking sector profit after COVID, it's been the best, and the reason is asset quality just disappeared. Asset quality stress disappeared. There were no bad loans, so banks were making more and more money. See, banks make money by interest income to give out loans, right? And then they have cost of operations people. And then the last cost item is provisioning for bad loans. If your provisioning for bad loans falls, then you make more profits. So if you look at the banking sector, ROA and ROE, it just went through the roof. ROA, it went through the roof because there were no bad asset quality issues. So, but the question you want to ask is, where do I get this data on banking capital? You will have to go to the RBI handbook. That will give you the data. Vaibhav, did I answer the question?
Yes, sir.
Right? See, he made this assumption. If you think about what Uday Kotak, he made this assumption saying that the banking sector capital was probably $40 billion. I think, if I remember right, he said that if there is, he said that, see, the banking sector is leveraged by about 12 or 13 times, right? Retail loans is about 40% of the bank, 40 to 45%. So he said that, there could be 15 to 20% loans that will go bad. And based on that, he came out and said that half the banking capital will be wiped out because of bad loans. And that half was basically $20 billion. That's how he came out with that figure. And
just a confirmation, by banking sector capital, you mean all the equity capital of top?
Just the the equity capital,
Understood.
So, but you'll have to go back to 2019, 2020, right? And
Yes,
put that in context.
Thank you so much.
Yeah. Okay. I don't think I have time, right? There's so many other topics. Like, for example, I had these many topics to talk about.
Yes, sir. Like, we are running a little short on time for this session, but we would love to have another session planned whenever you're free.
No, but you guys can let me know if you found this interesting or it was just too technical.
No, it is very interesting. Honestly, I am not a finance person, but this is a lot of new information that I could learn. So, yeah.
Okay.
So before we end the session, if you just don't mind answering one more question.
Go ahead.
Sir, I missed the part where you just mentioned that on a single day, you were talking about zero-day options.
Yeah.
Volatility. Can you just repeat the last question? You showed an article and there was disconnection from my side. So maybe you can just say it only. Essentially, what you were saying is that instead of equity buying, more so options derivative buying is what driving the market.
No, so what I was saying is, okay, so have you heard of option writers?
Yes.
Okay. So zero-day options are very cheap. Why? Because the option opens in the morning and expires in the evening. See, the value of an option is divided by two parts. One is the time value, right? And one is the intrinsic value, right?
Yes.
Now the time value shrinks a lot because you have only one day, not 30 days.
Correct.
And typically the options are issued at the index opening price, right? So the intrinsic value is also zero. So your intrinsic value is zero and your time value is nothing. So the option is very cheap. Now, it's like a $1 in a slot machine of a casino. So because of that, because it became very cheap and people were sitting at home, and people want to bet. See, everybody wants to bet, right? Real money gaming in India became very popular, right? People started betting on the internet, right? Likewise, you've heard of Robinhood as an app, right, in the US, where everybody can trade very easily. So because of that, everybody started buying the 0-day options because it was cheap. Even your grandma, grandpa, everybody, you're sitting at home. You're saying, okay, man, you know what? I'll bet on the market for one day. Your bet is very small. If the market goes up, you make a lot of money. If the market stays flat, you don't lose much money. That's how people thought. Just like in a slot machine. So everybody started buying these 0-day options. And then on the other side, there are writers of these options. So the open interest kept on increasing to such an extent that think of option open interest as a mattress on the index. The mattress on top, if it's a call option, mattress below as a put option, the writers. So suppose there's big news in one stock and the stock goes down, the option writers who are sold put options, they buy other stocks so that the index remains steady. Because if the index goes down, they will lose money, right? The guys who have written put options. So they pull up the other stocks so that the index remains steady. Likewise, if there's a big news in one stock in the index and the stock goes up, right? The index writers who have written call options, they will lose money. So what they do is they sell other stocks so that the index remains steady. At the end of the day, when the index expires, all these options expire worthless, and the option writers make a lot of money. So think of the option open interest as a mattress on both sides. It provides cushioning to the index, right? And as your index writers become bigger and bigger, if your mattress becomes thicker and thicker, you will feel lesser pain, right? It's like the pea. Remember the princess and the pea. As it becomes thicker mattresses, you don't feel much pain, right? You can't feel the pea. You have to remember that story, right, about the princess and she was sleeping on a mattress, and they wanted to test her. I forgot what the name of the story is. We all learned it when we were kids. So that's the point about option open interest. As it becomes bigger, the control of the market, and which is why if you look at India VIX, search for India VIX and see India VIX is the lowest in history today. Because India also, a lot of people are buying and selling options, right?
Yes.
Right. So our volatility of our market has also come down. So the riskiness of our Indian stock market has come down. So when people say riskiness of the stock market has come down, everybody wants to put in more money in the market because it's not risky anymore. Right?
Correct. So is that the reason that there is a lag between a news and actual reflection in the market?
Yes. Which is why if you think about it, Indian stock market is not reflecting real. I'll give an example. Okay, this is the last topic. Okay, very very quickly. You've heard that India GDP is up 8%.
Correct.
Right? Does anybody believe it?
Not really. Not in terms of gross product at least.
Okay. Do you believe that India's inflation is 0%?
Definitely not.
Yeah, but that's what the government is telling you. Okay, so I've stopped believing in government data in general, and I think you should as well. What you should do is, for instance, look at very simple data points like electricity demand in India. Electricity demand in India first 9 months of the year has only grown at 1%. That's it, 1%. So can an economy be growing at 8% real if your electricity is only growing at 1%? Not possible, right? Your diesel consumption has grown at 2%. Can an economy grow at 8% with only a 2% growth in diesel? Not possible. Right?
Not possible. Yeah. But for electricity, we can at least say that Indian power generation might not be enough, but if diesel consumption is not there, then too.
Yeah. No, I'm telling you, trust me. If we are becoming more and more richer, how can our electricity consumption reduce? Our per capita consumption of electricity is 1/10 in the world. Okay. A lot of people, you still have power cuts. I come from Bangalore. Do you know that Bangalore, which is the silicon capital of India, you have power cuts every day. If Bangalore has power cuts every day, imagine the rest of the country. So there is no shortage of power demand. And yet our power demand growth is only 1%. That means people are not buying power, right? There's something wrong, clearly. It's not, it can't be 1%. I mean, are people getting, like, you guys are getting jobs? If 8% of the GDP growth is there, are you guys getting as many jobs? No.
Yes,
Yeah. So start thinking about, I want to just say, start from basics. If people are saying something, don't believe it, start from basics. Then that's how you will learn. That's why I said the session is about critical thinking, right? Just try and connect dots. Like I explained to you about home loans and car loans and how many people, how big is India's middle income. By the way, a lot of this data would be available in any industry, whether in FMCG, whether you're a consultant, whether you're in banking, all of this data will help you, because at the end of the day, you all run businesses to sell some product, right? Okay, I'll end here.
On behalf of the Alumni Committee, I would like to extend our sincere thanks to Mr. Sujay Kamath for taking his time to join us today and share his valuable insights. Your session actually helped us with the micro and microeconomics. And I would also like to thank Professor Manish Popli, Chair Alumni Affairs, for his continued guidance and support. A special word of appreciation to Alumni Office, whose dedicated efforts behind the scenes made today's session possible. Finally, a big thank you to the audience for your enthusiastic participation and thoughtful questions. We look forward to welcoming you again to Wisdom, the Alumni Talk Series. Thank you once again. Thank you so much, sir.
Thanks, guys.